The moment the balance in your bank account crosses a certain line, your bank starts watching you on behalf of the federal government, and it is legally forbidden from telling you it is happening. There is a dollar figure that triggers an automatic report to a federal agency most people have never heard of. There is a second report with no dollar figure at all that can be filed on a transaction as small as a few $100s. And there is a rule that took effect in January 2026 that gives banks the authority to freeze a senior's own money for up to 15 business days without any warning, without any explanation, and without any obligation to tell you who to call to fix it. None of this is explained when you open the account. None of it is on your monthly statement. And the part that catches good, honest people is not what these rules are. It is what they do the moment they find out the rules exist. Because the instinct that feels safest is the one that can turn completely legal savings into a federal investigation. My name is Mason Parker. For over a decade, I have studied retirement benefits, senior tax programs, and the financial rules that affect seniors every year. Today, I am walking you through 7 specific things about your own bank account that the system will never sit you down and explain. Now, before we get into it, something I want to say directly. If you are not subscribed to this channel yet, look around at the people. These are seniors who got the bank freeze warning before their accounts were frozen, the payment protection information before the July payment cycle hit, and the tax correction details before the filing deadline passed. This channel exists to make sure you are in that group, not the one reading the comments wishing they had seen it sooner. Hit subscribe right now and turn on the bell. 2 more things before the 7. First, there is a specific scam running in 2026 that targets seniors around this exact topic. Companies charging hundreds of dollars to do something that takes 5 minutes and is completely free. I am going to show you exactly what it is and how to recognize it in seconds. And second, I have a bonus near the end that most seniors have never heard of. A government website where you can move your savings, earn around 4 to 5%, and the United States government itself backs every dollar with no bank limit and no FDIC cap. 15 minutes to set up. Stay with me for both. 7 things. Let us start with the rule that surprises the most people and the trap it creates. Under a law called the Bank Secrecy Act, which has been on the books since 1970, every bank and credit union in this country is required to file a report anytime you deposit or withdraw more than $10,000 in cash in a single day. That report is called a Currency Transaction Report, or CTR. And here is the first thing most people get wrong about it. It does not go to the IRS. It goes to a federal bureau called the Financial Crimes Enforcement Network, FinCEN, which operates inside the Treasury Department. Your bank files it, not you. You do not sign anything, fill out anything, or in most cases, ever know it happened. The bank has 15 days to submit it and keeps a record of it for 5 years. For the overwhelming majority of people, a CTR goes absolutely nowhere. Nobody calls, nobody shows up, nobody freezes anything. If you sell a car for $12,000 in cash and walk the whole amount into the bank the same afternoon, a CTR is filed and nothing happens to you. This is routine regulatory paperwork. Hold on to that fact, because what I am about to tell you is where good, honest people walk straight into a trap. When most people hear about the $10,000 rule for the first time, they think the same thing. They think, I will just deposit $9,000 today. Or I will break it up and bring in a few thousand at a time across the week and stay under the line. That decision has a federal name. It is called structuring. And under 31 U.S.C. Section 5324, structuring is a felony, not a civil penalty, not a warning letter, a felony. And here is the part that needs to land clearly before anything else. The money does not have to be dirty. You do not have to be hiding anything from anyone. If every dollar is completely clean, legally earned, legally inherited, legally gifted to you by your own family, and you simply break it into smaller pieces to avoid triggering the report, you have committed the offense. The source of the money is irrelevant. The act of deliberately breaking it up is the crime. Now, here is something that almost nobody explains when they cover structuring. and it changes how serious this law actually is. In 1983, Congress originally wrote the structuring law to require prosecutors to prove you knew that breaking up deposits was illegal. That requirement lasted 11 years. In 1994, Congress removed it entirely. Under the law as it stands today, the government only needs to show that you intended to stay under the $10,000 line, not that you knew doing so was a crime. Your ignorance of the law is not a defense and has not been since 1994. The penalties reflect how seriously this is treated. Structuring involving less than $100,000 in a 12-month period carries up to 5 years in federal prison and fines up to $250,000. If the total amount involved exceeds $100,000 over 12 months, the penalty doubles to 10 years in prison and $500,000 in fines. And the government can seize your entire account through civil asset forfeiture without charging you with a crime at all. There are documented cases of ordinary retirees and widows who had their entire life savings taken because the deposit pattern looked like structuring, even though every dollar was completely legal. Now, here is the angle most people covering this topic skip entirely, and it is the one that catches people who think they've found a way around the rule. Spreading deposits across multiple banks to stay under $10,000 at each one is also structuring the same felony, the same penalties, the same forfeiture risk. The bank you are depositing at does not need to know about your other banks for the pattern to be illegal. FinCEN aggregates transaction data across institutions, and the pattern is visible at the federal level even when no single bank sees the full picture. The rule that protects you is straightforward. Deposit your money all at once, every dollar of it at one time. Keep a clear record of where it came from. Never break it up to stay under a number, because the act of trying to stay under the number is the only thing that turns clean, honest money into a federal case. On top of the CTR, there is a second type of report, and this one has no dollar minimum at all. It is called a Suspicious Activity Report, or SAR. A bank can file a SAR on a transaction of $500, $200, or any amount if the behavior looks unusual to the automated system that monitors every account. And this one works differently from the CTR in one critical way. Under federal law, it is a crime for any bank employee to tell you that a SAR has been filed on your account. You could be flagged this week, this month, right now, and have no legal way of ever finding out it happened. What triggers a SAR is not the size of the transaction. It is a change in your normal pattern. If you have taken out $300 a week for 15 years and you suddenly ask for $8,000 to pay a contractor for roof repairs, the system flags the deviation. It does not know you are fixing your roof. It does not know your history. It knows the pattern changed, and pattern changes are what the software is built to catch. Other things that can trigger a SAR include round numbers that look like estimates rather than actual amounts, large cash deposits that do not match what the bank knows about your regular income, and any transaction that follows a recent period of dormancy on the account. Here is what protects you. When you are about to make an unusual transaction, bring documentation explaining it before you make it. A contractor estimate, a sale receipt, a letter explaining the purpose. That documentation ties a legitimate explanation to the transaction before the system flags it. A flag with a clear explanation attached resolves quietly. A flag with no explanation is the one that goes further. And one more thing worth knowing. Once a SAR is filed on your account, the notation enters a federal database. Your account and your transaction history receive additional scrutiny on future transactions. The best time to prevent a SAR is before an unusual transaction happens, not after. The first three things were about transactions. This one is about the account itself, and it is the newest rule on this list. In the last few years, banks and brokerages across the country have been given expanded legal authority to place a temporary hold on the account of any customer who is 65 or older the moment their automated system suspects that senior is being financially exploited. In January 2026, that authority was formalized through what regulators are calling the speed bump rule, connected to FINRA Rule 2166 proposals. The hold can last up to 15 business days, not 15 calendar days, business days. Weekends do not count. Federal holidays do not count. A 15 business day hold that begins on the Thursday before a long holiday weekend can stretch into 4 full calendar weeks on your actual calendar, 4 weeks without access to your own money, 4 weeks of direct deposits arriving that you cannot touch, 4 weeks of bills continuing to come due. This rule exists because elder financial fraud is a genuine crisis. Seniors lose over $3 billion every year to financial criminals, and the intention behind giving banks this power is completely legitimate. But here is what the rule creates for seniors who are doing nothing wrong. A perfectly clear-headed retiree who walks into their branch to withdraw $20,000 to help a child put a down payment on a house can be pulled into a private office, questioned about who the money is for, whether anyone pressured them to make the withdrawal, and whether they are completely certain about the decision. If the answers do not satisfy the bank's automated compliance system, the account is frozen while the compliance department investigates. And here is the part that frustrates people most once they are inside a freeze. The teller cannot lift it. The customer service line cannot lift it. In most cases, even the branch manager cannot lift it because the hold was placed by a separate internal compliance department that customers are not permitted to contact directly. You are not given a number to call. You wait. The way to stay ahead of this is to communicate before the transaction, not during it. Call your branch a few days before any significant withdrawal. Ask them to note the upcoming transaction on your account with a specific reason. Something like, I am planning to withdraw $20,000 on Friday for my daughter's home purchase. I wanted that noted on my account in advance. That notation gives the compliance system a legitimate explanation before the transaction happens, rather than leaving the system to flag it with no context. And set up a trusted contact on your account. A trusted contact is one person, a family member, or a close friend whose name and phone number you give the bank in advance. When the system flags a large transaction, instead of immediately placing a hold, the bank calls that person to confirm you are fine and the transaction is intentional. One phone call, one confirmation. The freeze never starts. Ask your bank specifically to add a trusted contact to your account. It costs nothing and takes one visit or one phone call to set up. Every account at every FDIC insured bank is protected, but only up to $250,000 per depositor, per bank, per ownership category. If you have $300,000 sitting in a single account at a single bank and that bank fails, $50,000 of it is not insured and can be lost permanently. People think bank failures belong to another era. In 2023, this country experienced 3 of the 4 largest bank failures in its entire history inside a span of roughly 8 weeks. Silicon Valley Bank, Signature Bank, First Republic Bank. The depositors who were under the $250,000 limit were fully protected. Anyone above the limit was at risk and was only rescued because of a political decision that no law requires anyone to repeat in the future. Now, here's the part most discussions of FDIC insurance skip entirely, and it changes the picture significantly for most seniors. The $250,000 limit applies per ownership category, not per account. And you can have multiple ownership categories at the exact same bank, each with its own separate $250,000 coverage. The most common ownership categories are single accounts, joint accounts, retirement accounts such as IRAs, and revocable trust accounts including payable on death accounts. Each one is treated as a separate insurance bucket at the same bank. Here is what that means in practical terms. A single person at one bank can have a single individual checking or savings account covered up to $250,000 An IRA at the same bank covered up to another $250,000 as a separate retirement category, and a payable on death account covered up to $250,000 per name beneficiary under the revocable trust category. One person at one bank with three different ownership categories can have $750,000 or more in coverage without moving a dollar to another institution. A married couple at the same bank has even more flexibility. Each spouse has their own individual account category at $250,000 each. Their joint account provides $250,000 of coverage per co-owner, so $500,000 total for the couple, and each spouse's IRA adds another $250,000 each. The same couple at one bank could have over $1 million fully insured simply by using the ownership categories correctly. Here is the free tool that shows you exactly where you stand right now. It is called the FDIC calculator. ED stands for Electronic Deposit Insurance Estimator, and it is available free at FDIC.gov. You enter your account types, balances, and ownership categories, and it tells you in minutes exactly how much of your money is currently insured and exactly how much, if any, is sitting above the protection limit. It takes about 5 minutes, and it may show you that you are fully covered, or it may show you that you have money at risk you never knew about. Go run it this week before anything else on this list. Now, I want to deliver the scam warning I mentioned at the start of this video, and I am covering it here after points 4 and 5 because the people running this scam specifically target seniors who just learned about account freezes and FDIC coverage gaps. Here is exactly how it works in 2026. A senior watches a video or reads an article about bank monitoring rules and coverage limits. Within a short time, they receive a phone call or an email from a company identifying itself as a bank account safety audit service, a federal compliance review company, or a senior financial protection specialist. The pitch is simple. They offer to review your accounts for government reporting flags, coverage gaps, and compliance risks, typically for a fee ranging from $200 to $500. Here is what you need to know about that offer. Everything they are proposing to check is free, and you can do it yourself in minutes. The FDIC calculator at FDIC.gov checks your coverage in 5 minutes at no cost. The CTR and SAR rules are public information published at FinCEN.gov. The Trusted Contact setup is a free conversation with your bank branch. There is nothing these companies access that you cannot access directly yourself for free right now. There is no authorized third-party service for bank account safety audits. There is no special federal database these companies can search on your behalf. They are following the exact free steps available to every American and charging you several $100s for the privilege of watching them do it. If anyone contacts you offering a paid bank account audit, a federal compliance review for a fee, or a service to protect you from government reporting flags, end that conversation immediately. The only resources you need are FDIC.gov and your bank branch. Both are free. Both are available today. Report any contact like this to the FTC at ftc.gov. These reports help track the operations and warn other seniors before more money is lost to it. Points 6 and 7 are the ones I want you to share with someone before this video ends, because what I am about to describe is the most widespread and most financially damaging mistake I see in retirement planning, and it is almost always made with the best intentions in the world. And quickly, if you are still watching and you have not subscribed yet, I want to ask you something directly. The people who are subscribed to this channel are going to see a video next week that covers what happens to your Social Security benefit if you are hospitalized and how to protect it before the SSA suspends it. That is the kind of information that matters before the situation happens, not after. Hit subscribe right now and turn on the bell so that video finds you when it posts. Now, point 6. At some point, a well-meaning person, a friend, a neighbor, sometimes even a bank employee, suggests to a widow or a widower that the simplest thing to do is add one of the children to the bank account so they can help with the bills. So the money passes to them easily later. It takes 10 minutes at the branch, the teller smiles, the form gets signed, and it feels like responsible planning. It is one of the most financially dangerous things you can do with your savings. And here is why, in 4 specific ways that most families never see coming until the damage is already done. Threat 1: creditor exposure. The moment your adult child becomes a joint owner on your account, the money is legally theirs as well as yours. Right now. Today. Not when something happens to you. Today. And that legal co-ownership means their financial problems become your financial problems. If your adult child goes through divorce, the joint account can be pulled into the divorce proceeding as a marital asset subject to division. If they are sued after a car accident or a business dispute and a creditor wins a court judgment, that creditor can levy your joint account because your child legally owns a share of it. If they owe back taxes, the IRS can file a federal tax lien that attaches to funds in an account bearing their name. If they file for bankruptcy, the bankruptcy trustee can claim their interest in the account as property of the bankruptcy estate. None of these scenarios require your child to have deposited a single dollar into the account. Every cent may have come from your pension, your Social Security, your lifetime of saving. The law does not care whose money it actually was. The law looks at whose name is on the account. Threat 2: your will has no authority over it. This is the one that tears families apart after a parent is gone, and it is the one almost nobody thinks about when they are standing at the bank branch signing the form. A joint account with right of survivorship passes directly to the surviving joint owner the moment the first owner dies. It does not go through the will. The will has no authority over it. Whatever your will says about dividing your estate equally among your children is irrelevant to the joint account. That account goes entirely to whoever is named as the joint owner, immediately, regardless of your intentions and regardless of what every other document you signed says. If you have 3 children and you added one of them as a joint owner for convenience, that account passes to that one child in full. The other 2 receive nothing from it, and there is no legal recourse after the fact because the account did exactly what a joint account with right of survivorship is legally designed to do. Threat 3: Medicaid look-back exposure. If you ever apply for Medicaid long-term care benefits, the state reviews 60 months of your bank statements. Every state, 5 full years of every transaction. The full balance of any joint account is treated as your accountable resource for Medicaid eligibility purposes, regardless of who deposited it. If your child transferred money into the joint account to help cover your expenses, that money from the Medicaid agency's perspective looks like your asset that then disappeared into account activity. The account structure that was designed to help you can create a Medicaid disqualification that prevents you from receiving benefits at exactly the moment you need them most. Threat 4: one owner can withdraw everything. Any joint owner can legally withdraw the entire balance of a joint account at any time without asking the other owners and without your permission. I have watched this tear families apart after a parent passes. One child empties the account before the others know what happened. The remaining children inherit nothing from that account despite the parents' clear intentions, because the surviving joint owner had full legal access to the entire balance and exercised it. The fix for every one of those 4 threats is called a Payable on Death designation, or POD. It is free to set up. It takes one short conversation at your branch, and it does everything people think a joint account does, with none of the danger. Under a POD designation, you remain the sole legal owner of the account for your entire life. Your children have no ownership interest and no access while you are alive. No creditor of theirs can touch it because they own nothing in it. No divorce proceeding can reach it because it is not their asset. No IRS line attaches through them because they have no legal interest in the account. No bankruptcy trustee can claim it for the same reason. And Medicaid counts only your assets, not theirs, because the account belongs entirely to you. But the moment you pass away, the account goes directly to the people you named on the POD form, immediately, without going through probate, without a court, without an attorney. without waiting months for a will to be processed. And it goes to everyone you named in the exact proportions you specified, not to whoever happened to be listed as a joint owner. Exactly who you chose and exactly how much you decided. If you have investment accounts or brokerage accounts rather than bank accounts, the same protection exists under a slightly different name. It is called Transfer on Death or TOD. Same concept, same protection, same conversation. At your brokerage, one form, no cost. Now, here is something almost nobody explains about the POD designation, and it connects directly back to point 5. When you add a POD beneficiary to a bank account, the account moves into the revocable trust ownership category for FDIC insurance purposes. And under FDIC rules, revocable trust accounts receive $250,000 of coverage for each named beneficiary. Name one beneficiary on a POD account and you have $250,000 in coverage on that account. Name two beneficiaries and it becomes $500,000. Name four beneficiaries and it becomes $1 million in FDIC coverage on that single account at that single bank. The same designation that removes creditor exposure, eliminates the will override problem, and protects you from Medicaid complications also multiplies your FDIC insurance coverage. It costs nothing to set up, and the protection starts the moment the form is on file. Now, the bonus I promised at the beginning, and this one applies to anyone who has more money sitting in a checking or savings account than they actually need for day-to-day expenses. The honest answer for most retirees is that a checking or savings account should hold roughly 3 to 6 months of living expenses. For most households, that is somewhere between $15,000 and $25,000, enough to cover bills, prescriptions, and unexpected expenses without having to move money around. Not much more than that. Everything above that amount is sitting in an account being watched by automated monitoring systems, earning very little and losing ground to inflation every single month. It does not need to be there, and there is a specific place for it that most seniors have never considered. The website is TreasuryDirect.gov. It is operated directly by the United States Department of the Treasury. Through it, any American can purchase Treasury bills and savings bonds directly from the federal government with no bank involved at all. Treasury bills in 2026 are yielding approximately 4 to 5%. And here is the critical difference from a bank account. Treasury bills are not covered by FDIC insurance because they do not need to be. They are backed by the full faith and credit of the United States government itself. The same government that backs FDIC insurance is the entity you are lending money to directly when you buy a Treasury bill. There is no $250,000 ceiling. There is no bank failure risk. The guarantee comes from a source that has never defaulted in the history of the country. Setting up a TreasuryDirect account takes approximately 15 minutes. You need a Social Security number, a bank account for transfers, and an email address. Treasury bills can be purchased in amounts as small as $100. They come in terms as short as 4 weeks, which means your money is not locked up for years. You get it back with interest in as little as a month and can reinvest immediately. For the money above your 3 to 6 month cushion, the options that make the most sense in 2026 are a high-yield savings account paying around 4%, Treasury bills through TreasuryDirect, or certificates of deposit spread across several banks so every dollar stays under the FDIC limit at each institution. Any of those three keeps your money working for you, keeps it fully accessible, and removes it from the surveillance environment of a large idle bank balance that the monitoring systems are built to flag. Let me bring all 7 together with one specific action for each. Write these down or come back to this section, because these are the moves that actually protect your money. Point 1, the CTR. When you need to deposit or withdraw a large amount of cash, do it all at once in one transaction. Keep documentation of where the money came from, a sale receipt, an inheritance letter, a gift record. The report is routine and harmless. The attempt to avoid it is the only thing that creates a problem. Point 2, structuring. Never break up deposits or withdrawals to stay under $10,000, not at one bank and not spread across multiple banks. One transaction, one record. The 1994 law change means ignorance is not a defense. The only safe move is one clean transaction with a clear paper trail. Point 3. The SAR. Before any unusual transaction, bring documentation explaining it. A contractor estimate, a purchase agreement, a letter explaining the purpose. Walk in with the explanation already in hand. The flag that has context resolves quietly. The flag with no explanation is the one that goes further. Point 4. The senior freeze. Call your bank this week and do two things. First, ask them to add a trusted contact to your account. Give them one name and one phone number of someone who can confirm you are fine when a large transaction is flagged. Second, before any significant withdrawal, call the branch a few days ahead and have the transaction noted on your account with a specific reason before you walk in. Point 5. FDIC coverage. Go to fdic.gov right now and use the free EDIE calculator. Enter your account types and balances, and it tells you in minutes exactly how much is insured and how much is not. If anything is sitting above the limit, restructure across ownership categories or across institutions. Take 20 minutes, know your number. Point 6. The joint account. If your adult child is currently listed as a joint owner on any of your bank accounts, call your branch this week and ask about converting to a payable on death designation. One conversation, no cost. It removes the creditor exposure, eliminates the Medicaid look-back problem, restores the will's authority over that account, and increases your FDIC coverage per named beneficiary simultaneously. Point 7. TreasuryDirect. For the money above your 3 to 6 month living expense cushion, go to TreasuryDirect.gov this week and look at Treasury bills. Government-backed, no FDIC ceiling, currently yielding around 4 to 5%, accessible in as little as 4 weeks per term. Your idle bank balance is not earning what it could, and it is sitting in exactly the environment the monitoring systems are built to watch. Let me close with something I want you to hear directly. None of this comes looking for you. Your bank will not call to tell you that your balance is above the FDIC limit. The government will not write to explain what the CTR triggers or what structuring means. The system is built so that everything stays exactly where it is, working quietly until the day you decide to move first. You now know where the lines are. You know what not to do when you cross them. You know the designation that removes 4 simultaneous risks with one free conversation at your branch. And you know the government website where your savings can work harder than they are working right now in a balance that monitoring systems were built to flag. The only thing left is one call to your bank this week and 20 minutes at fdic.gov. I built this channel because the financial rules that affect seniors are real. They are changing fast, and the people they affect most are the ones with the least time to sort through them alone.